Hi, I'm John Mousseau. I'm the president of Cumberland Advisors as well as the director of fixed income. It's a pleasure to be with you. It's Friday, September 27th, near the close of the day, and I wanted to give you a little bit of a framework for what the quarter was like in fixed income. You'll be hearing from Matt McAleer a little later on the equity markets as usual. But if you look at the quarter in whole, what was it? It was a rush down in yields, really unprecedented for such a short period of time. We saw the 30-year Treasury bond start out around a 255 to a 260, got all the way down to basically below 2%. And a lot of this all happened in the first 2 weeks of August. And the framework for this was really the negative yields that are in Europe. We think negative yields are a bad idea. They hurt banks. They really prevent banks from making money, borrowing shorter and lending longer. In this country, we also saw municipal yields come down a lot, but not as much as treasuries, to the point where actually longer municipal bonds are actually somewhat attractive, but on a relative basis, not a nominal basis. All of this adds up to Cumberland playing defense on bonds, and I'm going to show you why. If you look at this graph, it takes you back to 2014, and you can see the top line is the U.S. 10-year bond yield, and the lower line, yellow line, is core CPI, Consumer Price Index. And as you can see, as you get out to 16, you see the big drop in yields. What was that? That was Brexit. That was people being concerned about what was going on in Europe. And yields were low and inflation was relatively high compared to bond yields. It was an excellent time to play defense. We were playing defense then. Jump ahead and you can see how yields rose, particularly at the end of 16 when Donald Trump got elected and everyone thought there'd be a lot of growth, and yields went decently above inflation. A good time to expand durations and maturities somewhat. But then later on last year when yields went up even more, and we see in 2018 at the end when yields rose to try to compete with the stock market, yet inflation was pretty subdued around a 210, but that 10-year Treasury bond was about a 325. That was an excellent time to embrace longer bonds. You heard from us. We embraced doing it. We talked about extending durations, extending maturity. Shoes on the other foot now. That core inflation, which was 2.1 almost a year ago, is now 2.4. Wages are starting to increase. Labor participation rate is picking up. Unemployment has stayed low. We think that you could start to see further wage inflation. Yet, because of what's going on in Europe, combined with concerns about tariffs here, added to that some of the issues with Saudi Arabia that we saw last week, and yields have plummeted down. So now you have a 10-year bond that's roughly around a 165, but yet you have 240 on the CPI. This cries out to play defense again. That's what we're doing at Cumberland. We're using shorter maturities. We're using things that don't move much as interest rates rise. We're using floating rate bonds. We still own some longer bonds, but the whole portfolios have been moved a little closer to shore. And we think later in the quarter, in the fourth quarter, we will have an opportunity to capitalize on some higher interest rates. Thanks for listening and have a great weekend.
Hi, Matt McAleer. Great overview on rates from John. Talks about what we're thinking, what we're seeing. Keep in mind at Cumberland, fixed income analysis and equity analysis go hand in hand, trying to craft portfolios and allocations to create reasonable returns for the modicum of risk that a client is willing to take. So John feels that rates are in an area that he doesn't want to press longer term maturities, wants to keep duration tight. My thought and our thought, and that goes for David Kotok as well, is we try to see how is the equity market either agreeing with or disagreeing with John. Interestingly enough, it's tending to agree with John from our standpoint. Why? Talked about it last week. Fed cuts rates and interest rate sensitive equities rally. In a normal environment, you would expect that kind of margin pressure to knock down interest rate sensitives, yet our insurance holding in Tactical Trend goes out at all-time highs last Friday, had another nice week this week. That may be trying to tell us that rates are perhaps not at the bottom, but within a spot that a lot of downside on the 10-year and 30-year it isn't around the corner. Don't forget, about a month ago, late August, we talked about the 30-year Treasury coming down below the dividend yield on the S&P 500. It got down to 190, 191, below the, at time, 196, let's call it, payout on the S&P 500. Very rare. That went into some thought to push additional money in our strategies into equities. That's paid off, about 4% above that August 27th, 28th level. But what it also does is tell us that the market today is not fearful of significantly lower rates. So John will take that into consideration when he's trying to allocate and manage the bond portfolios. Likewise, we'll do the same thing. It was nice to see banks have a steady bid. It was nice to see insurance have a steady bid. Those are important sectors in the value side of the equity markets. We've talked now for a year or so that going back for the last 5 years, growth has dominated value. We've seen that start to back up. I wouldn't use the word reverse at all. Just back up a little bit. NASDAQ, for example, is down almost 2% this week, where the S&P was down, about 1%. That 2x performance is significant. In the past, that's been short-lived, and growth has come roaring back. It will be worth our consideration to keep an eye on value. Financials make up 20% of most of the value indexes. If financials can get a bid here on the back of higher interest rates, it may be worth us pushing more money from growth, which we're overweight, to value. Those are some of the things we look at on a day-to-day, week-to-week basis. So remember, keep your portfolio buckets in line with your objectives. Have a short-term bucket and a long-term bucket. Don't let headlines make you take a short-term decision to liquidate an entire portfolio. Try to work it in pieces and buckets. If you find yourself emotional where you're affected by headlines, at least limit it to a portion of your portfolio. Headlines are just that. They come and go. You saw the rally off of the impeachment news midweek. You saw today off of news that the White House may limit investment inflows into China. The market went, the Dow went from up 50 to from up 125 to down 50 in 5 minutes. By the end of the day, we had gotten a little rally back as some of that initial emotion wore off. Try to control emotion. Try to realize that headlines are only one data point, and a small insignificant data point in the overall trading of global equity and fixed income markets. Everyone have a great week. We'll see you next Friday.